Hi business creators, it's Claire from Claire Wright, and today we're going to be talking about managing your cash flow, because there's always a lot of talk about cash flow when it comes to business finances, though I would say it applies equally to personal finances. You know, cash is king, cash is the lifeblood of any business, etc. So let's dig into what cash flow means, how it might be showing up for your business, and how you can start to manage it. So firstly, it's important to talk about what is the problem of cash flow. So cash flow is the movement of money through your business, essentially. Clients send you money as income and you spend money, send it to suppliers as expenses. If you have staff, it would go on their salary and superannuation. And obviously you send money to the tax department for various taxes, including GST and income taxes. And all of those things, expenses, anything to do with payroll and taxes, are all flowing out or outgoings from your business. Seems fairly straightforward. So managing your cash flow is ensuring that there is enough money available to pay those expenses, those salaries, those taxes when they are required. And this is especially important in businesses where income is produced after the expenses are incurred. So maybe for you that's buying supplies to create products, or you need to do the work and maybe you need to pay somebody else to help you with the work, or maybe there are tools, softwares, example, that help you do the work, which you then bill after the work is done, after the expense is incurred, and you get paid, 15, 30, 45 days later. And the reason cash flow is important is because nobody wants to be in a situation where their business doesn't have enough funds to cover its needs. And that is where managing your business cash flow begins. So before we dive into the steps on the how-to, I just want to cover off the signs that you aren't managing your cash flow, how this may be showing up in your business. So the first major sign that you aren't doing a good job of managing cash flow is that there never seems to be enough money in your business bank account to pay the things you need to pay. For many sole traders and solo business owners, what this shows up as is the owner regularly needing to transfer money into the business from their personal bank account. However, it's important to note it's not always that straightforward. If you're constantly putting money into your business bank account, there are actually 3 different issues this could indicate. So the first one is the personal problem. So for example, let's imagine $1,000 comes into your business from a client, and then the owner withdraws 100% of that for their personal use. Then sometime, maybe a week later, the owner needs to put back $350 to pay for certain outgoings. In this scenario, the issue isn't necessarily the business's cash flow, but the owner is almost disregarding the business's needs, because there are certain things the business has to pay. So if the business owner takes out all of the money that comes in, cash flow is going to be a problem. And I'd actually suggest the cash flow issue could potentially be at the personal level if the business owner needs to withdraw everything that came into the business. So we need to actually check here the balance of money coming into the business from the owner and the money going out of the business to the owner to see how that ratio works. That's the personal problem. So maybe there's a cash flow issue at the personal level. The second pattern highlighted by constantly needing to put money into your business is the profit problem. If almost all the cash that comes in from clients and customers is being used purely for business purposes, and the owner is still needing to regularly put money into the business, that actually suggests the business isn't generating enough income to cover the outgoings. So let's use an example. Say that $6,000 came into the business during the month. The owner doesn't withdraw any for personal drawings or salary, how we would like to describe it, and none of it is used for personal reasons. You maybe purchase something in the business that you use for personal. But then at the end of the month or sometime during the month, the owner needs to put in $500 to cover some expenses. That actually suggests a profit problem because everything that is coming into the business is being spent on the business and the owner is still needing to contribute. So I would say that is actually a profit or an income problem. And then the third one is the cash flow problem. And this is really highlighted when at times the business has more cash than it needs, but then at other times there just isn't enough cash to cover the outgoings. This really is highlighting a timing difference. That's a key part of cash flow. And it's the difference between when money comes in and when money goes out. And this really is the reason that all businesses need some sort of startup capital. It's money to balance out that timing difference of when money is spent and when money is earned. And this difference, this timing difference, generally is captured either in accounts receivable, which is work that has been invoiced but not paid, or in work in progress, which is work that has been completed or partially completed but not yet invoiced. So if those are adding up to the amount of cash needed, that's highlighting it's a cash flow, a timing problem. So with the example, let's say the business sends an invoice for $1,000 to a client in May for work that's already being completed, but that invoice isn't going to be paid until sometime in June. But between now and the end of June, the business actually needs to pay for its annual software subscription and doesn't have the cash available. That would be a cash flow problem because there's a requirement to pay something that's being used to generate income that's all happening within the business, but the cash isn't available. So now we've understood the different ways it can show up, but actually the different problems it can highlight. Let's talk about how you can start to manage your cash flow. Now there's a couple of aspects it's important to understand. And remember, when we put this kind of plan or forecast or whatever into place, a lot of it's going to be estimated because do you know how much you're going to be spending on expenses in 3 months' time? Probably not. Do you know how much income you're going to be making in 3 months' time? Probably not. So a lot of this is estimated, but remember you can update this as you go as the numbers are confirmed. So the first thing it's important to understand is the who and what. So this is covering off how cash is generated and utilized, those incomings and outgoings. So we start with just simply listing out the different places money comes into your business and estimate how much we expect that to be. And then we list out the different places that money leaves your business and estimate how much that will be. So we simply just have a list of income and expenses, and you should be able to generate that from your historical and from your knowledge of the business. The second aspect then is to figure out the when. This is the flow part of cash flow. So from that list of what's coming in and what's going out, you need to estimate when that transaction will occur. So is that going to happen regularly? It's going to happen on a particular date. And when you do this, make sure you do cover off those regular transactions as well as the more ad hoc transactions. So things that happen once, things that happen once a year, things that happen once a quarter. And also it's useful to add in some notes here around when exactly it will occur. Is this weekly? Is it monthly? Is it on the 15th? Is it on the 30th of June, etc., etc. So you can start to track the when. The third part we're going to need is a balance. So what are we bringing in to start this cycle? So you need to put a figure on what funds are already available in your business. For example, if there is $124 in your business bank account, then that is your opening balance. You will add to that $124 as money comes in, and you will take away from that $124 as money goes out. So then we bring together these three aspects, the who and what, and the when, and we use that starting balance. So we map those together either in a plan or a timeline, money coming in, money going out, and what we started with as well. And with that information, you should start to see a pattern, potentially, particularly if you're doing monthly sort of work, monthly billing, that sort of thing, and also it will highlight for you when your funds may be insufficient to cover those outgoings. If you do need help getting a handle on managing your cash flow, then please get in touch. We can have a free chat and I can just give you a bit of an outline and we can go through some of the things that you would need to cover off. And I'm happy to do that for free and have a chat about your business as well. If this video has been useful, I would love you to give it a thumbs up or comment and let me know how you're going to start managing your cash flow. And as I said, if you do need more help, get in touch and we can talk about managing your business finances to make them quicker, easier, and actually work for your business.